My name is Jake, welcome to the channel. In today's video, we're gonna do another review my pie video. I cannot believe it. I mean, if I look at my channel over here down to the bottom in the series that I created, Review My Pie, I created this about a half a year ago. The time has just been flying by. It's incredible to me. So this is the 10th video of this series and I absolutely love it. I love reviewing subscriber portfolios. I invest for dividend growth. My wife and I, we're looking to achieve financial independence. I have a long-term investing time horizon. The portfolio is not a pure growth portfolio where I'm looking to liquidate the shares and then, use the growth of the portfolio and then sell the shares so that I can fund my expenses. The goal is to fund my lifestyle in early retirement in my mid 40s or actually early 40s, just purely from the dividends. So once again, if you're brand new to the channel, welcome. If you watched a few of my other videos, welcome back. Let's take a look and see at the portfolios that we're going to review today. So the first portfolio is going to be from a 35-year-old here in the United States, 20-year-old here in the United States. The third portfolio is going to be from an individual that's in their 40s, also here in the United States. And then the fourth portfolio is from a 22-year-old in Europe. So as always, I don't review the portfolios in advance. So when I'm looking at the portfolios, I'm looking at them for the very first time. I don't script what I'm gonna say in these reviews. And also, as always, friendly disclaimer, I'm not a professional financial advisor. Everything that I share here in this video should not be considered professional financial advice. It's just merely for your entertainment. All right, let's take a look at the first one here. The first one is from Brandon. Brandon writes, "Hello, sir. My name is Brandon. I would first like to say I love your channel and really appreciate the time you take out to help others." Brandon, thank you so much. I really appreciate that. I'm 35 years old, here, U.S. citizen, and plan on contributing at least $200 a week into this pie for the next 12 years. The goal of the pie is supplemental income, as I will have a state retirement as primary, but the wife will not. I apologize, my pie isn't divided into categories like most, but I am fairly new and did not understand the importance of that when I built this one. I do have some companies under the growth section that do not currently pay a dividend, with the idea of selling them to buy high yield dividend stocks when I need them, or for spare cash flow when the time comes. I understand you're not a financial advisor, but would appreciate your guidance you have for me. I also have a deferred comp plan through my job, which I contribute $200 bi-weekly, and a Robinhood account. I do not plan on adding any more capital to the Robinhood account, but rather letting the monthly dividend grow the account on its own. I do not have a Roth, as I do not plan on waiting that long to access the money. Okay. I have included screenshots of my Robinhood account, which I started late March of this year, and I am prepared for OCLC to go to zero. So you're prepping us for that one. Okay. Thank you, sir. All right, Brandon, let's take a look at your portfolio. So your portfolio is up a whopping 127%. That is huge. Looking at your current dividend yield, you have a good, healthy dividend yield. This is actually really healthy from a portfolio perspective. You have a low expense ratio and you have 62 holdings. 62 holdings, absolutely fine. I think 62 holdings is very manageable. And because you have an expense ratio, you likely have some ETFs in here. So you got it broken down to in 4 categories: dividend aristocrats, you got dividend stocks at 25, you got growth at 20, and ETFs at 20. All right, let's take a look at your first slice here with the aristocrats. You have 25 holdings with a 3.5 dividend yield and 0 expense ratio. Good healthy performance. And let's see, you got in here, everything is equally weighted. Okay, great. So you got Walmart in here. Walmart is great. You got Stanley, Black & Decker, great. You got Target, you got Pepsi, you got Procter & Gamble, McDonald's, Lowe's, Home Depot, Kimberly-Clark, Johnson & Johnson. This is right up my alley. This is great. So with all of these, like, I like it how you mentioned you break down growth in another slice, but like these are such great companies. Every single one that we've seen here so far, these are all sleep well at night. You can go to bed at night feeling very comfortable that McDonald's, Procter & Gamble, Pepsi, Kimberly-Clark, Johnson & Johnson, all of these companies are going to be around for decades. I mean, I could even go as far as to say centuries. I mean, like these companies are going to be around for your great grandkids. And this is just incredible. Okay, so you got Emerson Electric, great. Industrial, it's a little bit of a slower grower, but higher current yield. Dover, same thing. GPC, same thing. Chevron, okay. Chevron is my favorite energy stock. So if you're going to purchase one energy company, in my opinion, Chevron's the best. I guess I could be a little bit biased because that's where I always get my gas, but looking at their balance sheet, looking at their track record, looking at the company, the diversification, it's a great energy company. Caterpillar, great. Clorox, great. Aflac, AbbVie, 3M, Coca-Cola, ExxonMobil. ExxonMobil is a good one. I am very curious if they're going to be able to sustain their dividend. Very good question. AT&T, great. Bank of Montreal, ADP, and Altria Group. These are so great. These are so great. I would say 90% of these, 92, 93% are all in my portfolio. So these are great. With these, you're going to see, okay, you got a 52%, return. This is not including dividends over the last 5 years. This is not your Tesla. This is not your Etsy. This is not, your Amazon. These are great established companies that are cash flow machines. These companies are going to pay you dividends until, with a few exceptions, maybe with ExxonMobil question mark. For the large majority of these are going to be pumping out cash flow for generations to come. This is a great slice. Let's see what you have in your others. You have dividend stocks. So I'm assuming these are the aristocrats, 25. Dividend aristocrat, for everybody. It's a company that's increased its dividend for 25 consecutive years. Dividend stocks, you have 22. You got Waste Management, and these are all equally weighted as well. Very good. Waste Management, Southern Company, Union Pacific, Travelers, Texas Instruments, PFG, Nexter Energy, IBM, these are all really good companies. Really good companies. Disney, once again, I'm recording this video here on Wednesday for the, usually we do it on Sunday. We just saw news that Disney may be slashing its dividend again. It's kind of a roller coaster. I am sticking with Disney. I'm holding on to it, even if they suspend their dividend here in 2020, even if they suspend it in 2021. I'm going to hold on to it. It makes only a very small percentage of my overall portfolio. Verizon, great. Raytheon, great. Lockheed Martin, also Starbucks. Morgan Stanley. Capital One. Okay, so here's the thing. Here's the deal. I am a Capital One credit card holder. I use Capital One. I really like Capital One. But as a dividend company, I'm not the biggest fan. Doesn't have a good track record. I think they just, if I'm not mistaken, they just cut their dividend here this year. It's not like American Express where they've had that consistent growth. Capital One is probably I love the company. I love the credit card. I have the venture card from them. But in terms of from a dividend perspective, not a great dividend company, in my opinion. Deere, okay, it's a good one. Cisco, great. And Pfizer, great. So yeah, out of the 22, I like all of them with the question mark with Capital One, my opinion. Costco's here, Duke in here. Yeah, the rest are really great. Let's take a look at your growth slice here. You got 11 in here, equally weighted except for the Tesla down here. You got Visa, great company, great growth company. MasterCard, great. Alibaba, Microsoft, Apple, BlackRock, Tesla, Amazon, Honeywell, Alphabet, and Facebook. I think these are all really great companies. I think one that you could even add in there that I really like from a growth perspective is I really like Square. I really am a big fan of Square. I'm not a shareholder of Square, but I don't know. I just think it's a great company. So, but yeah, Honeywell could actually go in your dividend slice. But yeah, you got Amazon, you got Tesla, BlackRock as well, by the way. But yeah, these are, none of these companies all of these companies are going to be around. So, and you even mentioned in your email, you want to have the flexibility if in the future you either sell the company and buy a dividend stock, or you sell it to, say you buy a house. Maybe down the road you need to buy a car, or you want to go on vacation. Who knows what, right? It gives you flexibility, which is great. ETFs. Let's take a look and see what you have in ETFs. Before I forget here, the target allocation I think is fine. 20% in growth, 20% in ETFs. There's nothing here that really stands out to me and says like red flag. I think this is absolutely fine. Let's take a look at your ETFs. You got 4 of them: VGT, VYM, VOO, and ARK. All right. So VGT, absolutely love it. VYM, absolutely love it. VOO, love it. And I will admit, I don't talk a lot about this, but I actually really like ARK. I don't currently invest in it. However, I really like this for, if I were to set up in the future when my wife and I, when we have kids, this would be something that I would consider for one of my kids. Maybe. I tend to change my mind from time to time when it comes to this, but I've been looking into ARK a little bit more, and I am impressed. I'm impressed. But back to the ones that I know a little bit more about when it comes to the S&P 500, VOO is great. VYM is a great high dividend ETF. Another one that I really like in my portfolio is the high dividend from Schwab, SCHD, ticker SCHD. And VGT is amazing. Like the information technology ETF from Vanguard, VGT it's got a great track record. It has a little bit less diversification than a QQQ, for example, because it's just focused on information technology, but it has a lower expense ratio. I really like it. Brandon, thank you so much for sending over your portfolio. This is great. It's a little bit unconventional in terms of what I invest in. When I say unconventional, I mean unconventional for me. But I absolutely love your portfolio. I think it is great. I think it can work very, very well. You have it broken up with your dividend focus. You have it broken up with your growth focus. You have it broken up with your ETF focus. I absolutely love that. I love it. And so I think you know what you're doing. You have a great starting yield given your, the gains, the returns that you've seen in the portfolio. Assuming you've been dollar cost averaging and buying into this portfolio, this is really great. I think it serves its purpose. If you want to set it up this way, you're still getting exposure to growth. The thing that I like about this growth slice, though I don't do it personally, what I like about it is having this growth slice, it gives you options. It gives you flexibility. You don't know what kind of expenses you're going to have. You don't know if you're going to have to liquidate the shares, etc. It gives you flexibility in life, and I think it can work very well. Thank you again for sending over your portfolio. All right, let's take a look at the next one. The next one is here from Bryan. Bryan writes, I hope you, your friends, and family have been well during these times. Thank you so much, Bryan. I really appreciate you saying that. I hope yours as well. Thank you for your informational content. I would like you to review my M1 Finance Pie when you have a chance. I'd like any thoughts, both good and bad, that you have, as well as somewhat new. I'm somewhat new to investing. I have less than a year of experience. I started investing in August of 2019. I'm currently 20 years old, a full-time student, and invest $200 each month. I plan on investing 10% of each paycheck once I graduate and have a good paying job. My goal is to amass $1 million by 2060. That is great. I plan on turning 60 years of age that year. That gives me a time horizon of 40 years. That is great. So let's see. You continue writing down here. I'm not focused on a high dividend yield. I'm more focused on getting the value of the portfolio to be the highest it can be. I reinvest the dividends. I try creating a diversified portfolio, which I believe may be less risky, especially in times of economic downturn. I'm aware less risk is associated with less reward. Any thoughts are greatly appreciated. Thank you, Bryan. All right, so Bryan, you also sent me another email with a different link because you made a few updates in your portfolio. So I'm going to use the other link that you sent in a different email. Alrighty, Bryan. So your portfolio's up 68%. You have a small expense ratio, good healthy dividend yield, and 48 holdings. So your time horizon is, you said 40 years. Right? You're looking to retire at the average age or the traditional age, or at least when it's available for your, for a Roth IRA or 401k. My first piece of information there would be, I just created a video last week around the order of accounts that you invest in. If you're looking to retire at the traditional age of 59 and a half, the best thing that you can do, in my opinion, is take advantage of those tax sheltered accounts. It's unbelievable. The tax savings that you're going to get with that is remarkable. I'm talking about a Roth IRA, an HSA, a 401k, Roth 401k, etc. So definitely something to take a look at, especially if you're looking to retire at 59 and a half or later. Okay, so your portfolio is broken up into 12 slices. It's 25% in ETFs. You also have bonds, you have technology, you have real estate at 10, non-US ETFs at 10%, consumer staples, healthcare. All right. Hey man, you're what? You're 20 years old? You're 20 years old and you're already setting your portfolio up in this fashion. This is great. I am so excited for you that you're already thinking about this. You're thinking about diversification. You're thinking about setting your portfolio up. I can imagine that you want to set this up. You probably put a lot of time in researching how to set up your portfolio, the way that it's going to meet your goals. And you're probably very passionate about it. I mean, if you just started investing here recently, you're learning about this, it gets really, really exciting. The first thing that I do want to note is I want you to ask the question for you, why do you have 15% in bonds? The only reason, in my opinion, I guess there's two reasons. The only two reasons why a 20-year-old should have any bonds at all, is the emotional benefit that comes with investing into bonds. And the second is if you wanted to time the market and sell out of bonds and then reallocate your portfolio into equities when the market goes down. Those are the only two reasons why anyone, in my opinion, that is 20 years old would ever consider holding bonds. If those two reasons are not the reasons that you chose to hold bonds and you chose bonds for diversification, I would encourage you to reevaluate that strategy. Let's take a look at your first slice here, your ETFs. You got VOO, you got USMV, you got VUG, so you got the growth one here. You got VIG, SCHD, GGRO, and IUSV. Okay, so when you say you have 40 years is a long time. 40 years is a lifetime of compounding, a lifetime. So in this case, you really, really want to skew your portfolio to growth. And the cool thing is if you get this into a Roth IRA or a tax sheltered account that you don't pay any capital gains tax when you liquidate shares in retirement at 59 and a half or later, you're not going to pay any taxes. So say, for example, you invested into the growth ETF, it grew twice as fast as the Schwab. You're not going to pay any capital gains on those gains. That strategy can work if you just want the dividends to reinvest and you never want to sell your shares. I think VIG is really, really good. VIG is going to be a great ETF for you to have dollar cost average into it and not have to worry about really anything. It's going to just keep growing and growing. VIG is really good. DGRO is also really, really good. The Vanguard Growth Index Fund is a good one, but I mean, it's not really a dividend focused portfolio. Like it's not really focused on the dividend growth. It does have a dividend. It is growing, but that's not really the main goal of VUG. Whereas with VUG, excuse me. Whereas with VIG, that is exactly the goal of this fund, this index fund. Okay, so yeah, something to be aware of. Another one that I also really, really like is I like VGT. I really, really like VGT, especially in a portfolio like this, and especially where you have so much time ahead of you. You're going to be amazed by the capital appreciation that you're going to see in 40 years. And if this isn't a tax sheltered account, once again, you're going to have a lot of options to do with that, to do it with the money that you're going to have there. Let's see your bonds. What bonds you got in here? You got BNDX, the international one, you got BND, and you have corporate bonds. Okay. Yeah, once again, I stand by what I said earlier. With these, I would encourage you to reevaluate having bonds in there. However, with the bonds that you do have in here, they're really, really high quality bonds. Technology, 14%. Got Microsoft, Intel, Alibaba, Cisco, Facebook, and SAP. Okay, great. I'm trying to think. Microsoft at the highest allocation, really, really good. I think this could work really, really well. I'm trying to think if there's any others that come to mind that I really like. I really like Visa as well. Visa is it is actually classified as a technology company, not a finance company. I would recommend taking a look at Visa. Visa would be a really, really good addition to your portfolio, in my opinion. Real estate, what do you got here? You got AMT, you got MPW, you got Realty Income, you got PLD. Oh man, I love seeing these in here. I love seeing Digital Realty, Prologis, and American Tower. These are if you didn't have those in there, those are the exact three that I was going to recommend. So you probably follow my channel. I always talk about these. These are great. You got Realty Income in here as well, which is also really, really good. I don't know as much about MPW. It's a healthcare REIT. I'm not as familiar. I haven't researched it as much as the others, but I absolutely love AMT. I really love Realty Income. I really love Prologis, and I really love Digital Realty Trust. Great. What do you got here? And also with the allocation, 10%, absolutely great. Really, really great. Non-US ETFs. Let's see what you got in here. Full disclosure, I'm not so familiar with international ETFs. The ones that I am familiar with are VWO, and the ETF that I have is VXUS, ticker symbol VXUS. The reason why I like it is it's international exposure minus US. A lot of these international ETFs also have US-based companies in there, so it's something to be aware of. I like VWO and I like VXUS because there you're getting pure international. You're not getting like 30%, 40% of the US market included into it as well. So it's something to be aware of, but I think this is absolutely fine. I also like VIGI as well. It's a good one. Let's look at your consumer staples. You got 7% in consumer staples. Coca-Cola, Pepsi, Hormel Foods, Kimberly-Clark, and Walmart. Okay, with your time horizon, I think it's a little bit of a missed opportunity to not include a little bit of a more growth-oriented approach to this. What I would recommend you look at is Costco. Look at Costco. Costco is incredible. Like Walmart is really good, but I would also look at Costco as well, especially where you're talking about 40 years. I would personally, consider reducing Coca-Cola and increasing Walmart, Costco, Pepsi because of your time horizon. Healthcare. Let's take a look at and see what you got in healthcare. You got Merck, you got MDT, you got Johnson & Johnson, you got AbbVie. These are really, really good. I think with MDT, it's a high growth company. Another one that you could look at is ticker symbol BDX, another really hyper growth one, and also Stryker. Stryker is also another good one. But these are all, in terms of the quality of the companies in here, these are all really great. In terms of your time horizon, you're gonna. Yeah, I mean, the cool thing about M1 Finance is you're getting the current income from AbbVie and Johnson & Johnson and Merck, for example, that higher current yield, and that's going to be reinvested into the other parts of your portfolio. That's one of the things I really, really love about M1 Finance. And so if you do have a current higher yielding stock in there, I think personally it's okay because the DRIP, the dividend reinvestment plan, is not just being reinvested into the single company, but to the overall portfolio. That's one of the things I absolutely love about M1 Finance. Looking at industrials, you got Waste Management and Honeywell. These are great. I also like 3M, but I think, Waste Management, absolutely great. Honeywell, great. Financials, you got T. Rowe, you got MetLife, really good one as well. JP Morgan, Discover Card, and Bank of America. These are fine. I really like MetLife. I don't have MetLife in my portfolio. I've done a lot of research. I've considered adding it. Really, really good. T. Rowe is also great. Another one that you can take a look at that would make a great addition is ticker symbol SPGI, Standard & Poor's. I think that's make a really, really great addition to your portfolio given your time horizon. Let's see what you got here in energy. You got Chevron, Valero, and you got Royal Dutch Shell. Yeah, I mean, energy is what it is. I personally, in my portfolio, I used to have Chevron and ExxonMobil, and I got rid of both of them because I have exposure to them in VYM and other ETFs, for example. And so I personally, I don't even invest in energy. But I think if you are going to invest in energy, having it set at 3%, I think it's fine. I think the companies that you have in here, I think these are fine. All right, let's take a look at what you have in utilities. Utilities, you got Dominion and you got NextEra Energy. Yeah, I think these are fine. I really like NextEra Energy. I also would recommend taking a look at water utilities. Water utilities are also really, really good. They have a really great dividend growth rate as well. And then lastly here, you got communication at 1% and you got Verizon. Verizon is good. Another one that you could take a look at is Comcast. Comcast is pretty good. I know some people from a consumer side of things absolutely hate Comcast, the customer service, etc., the monopoly that they have. But from a dividend perspective, it's a pretty darn good company. All right, well, thank you so much again for sending over your portfolio. I really like your portfolio. Really the only thing that, once again, that I would recommend you taking a look at and reevaluating is the bonds. And, you know, let me put myself in your shoes. If I could tell my old self, my old, younger Jake at 20 years old with a 40-year time horizon, I would tell my younger self, Jake, you don't need any bonds, 0 bonds. But that's me. Everybody's got to decide for themselves. But once again, thank you so much for sending your portfolio. The next portfolio here is from Toffee. Toffee writes, hello, I love your videos and hoping you can help review my portfolio. Well, Toffee, thank you so much. First off, I really appreciate you saying that. You're right here. I'm a late investor, 40s, but looking to retire around 65. This portfolio is sort of a hybrid where I'm trying to grow my dividends tax-free, so you're probably talking about a Roth, but at the same time own high growth potential stocks. I've been splitting my money more into growth, but with a Roth, I can only deposit $6,000. That's correct. I would like to get more aggressive in my gains, so any input you have would be appreciated. Thank you. Well, first off, thank you so much. I think a lot of people think that it's either one or the other. You can either have growth or you can have dividend growth or dividends. And in my channel is all about, well, I'm here to say that you can get both. You really can get both. All right, let's take a look at your portfolio. So you're up just about 100% over the last 5 years. Good, healthy expense ratio. Very, very good. Dividend, also really good. Over 3%, 46 holdings. And this is in a Roth IRA. So this is, for all of you out there internationally that follow the channel, this is in a tax sheltered account. So what that means is you pay the taxes up front and on the contributions, and then once you're 59 and a half, you can take out the gains tax-free. The distributions are then tax-free. So pretty cool. The only caveat there is you have to wait until you're 59 and a half if you don't want to pay the 10% fee. So you got a few slices here, 6 slices. You got gains. So I'm assuming gains is your growth slice. You got your dividend aristocrats, you got your ETFs, you got your monthly dividend reads, you got your banks, your finance, and you got your bow tie dividends. Let's take a look at your gains here. What do you got? You got some Tesla. All right, cool. You got Tesla, you got, I'm going to slaughter the name here, Illumina. Nobody make fun of me in the comment section. I can't pronounce that for the life of me. You got Square. Okay, very cool. So you got Square. You got, these are your 3 largest holdings. Okay, that's great. You got AMD, you got Disney, you got Walgreens, you got Uber, Nordic American Tankers, NEO, and you got Tapestry. All right, so this is in a Roth IRA. Okay, so you're investing directly into Tesla, directly into Square and such. So you believe very strongly into these companies. I think that's great. I think this strategy could work very well. If you ever feel like you're getting overwhelmed, or if you ever feel like, oh man, Tesla, the roller coaster in Tesla has just been driving me crazy. I don't know if I can handle it. I'm just speaking hypothetically. We've never spoken. I don't know. But I could imagine that that's how it could be with me. But regardless, you want to get that growth. You want the growth of Tesla. We were talking about this earlier. We were talking about ARK earlier, this ETF. I've been doing a lot of research into it because so many people have been commenting on my videos asking me, hey, what do you think about ARK? What do you think about ARK? And I've taken a look at it. I really like this ETF with the one exception of the expense ratio. The expense ratio is pretty high. However, it does protect you from that. You get the upside potential growth, but it shelters you from that downside risk of, a company like a Tesla, which I'm not saying it will, but that downside potential risk of it, they have a scandal or whatever and they go bankrupt, right? It protects you from that. And if you wanted to, this is why I'm so interested in this, is you got Tesla and you got Square in the top 10 holdings of this ETF. So just kind of a random thought here, but it's something that maybe you could take a look at if that would be, maybe interesting to you. But yeah, all of these companies, I think these are fine. You got Disney in here. Disney also pays a dividend, but it's not really known for its dividend. Let's take a look at your other slices. You got your dividend aristocrats. You got 15 in here. You got some high yielders. AT&T yielding almost 8%, Altria Group over 8% at the making of this video. Johnson & Johnson, great. AbbVie, Abbott, great. Waste Management, great. Toll Brothers, they've gone up a lot here in 2020. Home builder. The reason why I know Toll Brothers is I was even thinking about buying a house from them, or having them build us a house here in Austin a couple of years ago. Pepsi, Procter & Gamble, Kimberly-Clark, Consolidated Edison. I mean, these are your high dividends. So when you said in your email, you said, yeah, it's either one or the other. You either have dividends or you have growth. With this approach, when you compare AT&T and Tesla, I mean, yeah, of course, it's either dividends or growth, right? But the kind of companies like Johnson & Johnson, for example. Johnson & Johnson is a great dividend growth company. It has a good dividend, good starting dividend, but it's also growing. It's a growing company. But if you look at other companies like Waste Management is a perfect example of a company that pays a dividend. It's a dividend growth company, but over the last couple of years, it's actually beat the S&P 500. It's kind of gone up and down over the last couple of years, but it's beat the S&P 500. And so, not recently though. I think the last time I checked it, before COVID, it was beating the S&P 500. But I mean, it's a great dividend. It's a great growth company, but it's also a great dividend growth company. And so, I believe that you can get both. You can get the growth with the dividend growth. With a company like Waste Management, or for example, like with a Microsoft. A Microsoft is another great example of a dividend growth company. Okay, let's take a look at your ETFs here. You got SPHD, you got Noble, you got VOO, you got Vanguard's real estate, financials. Okay. Yeah, so like I said, if you wanted to add that ARK ETF, that would be an example here. If you wanted to add a high dividend ETF in addition to SPHD, right, you could do that here. The cool thing about the way that you have your portfolio set up is it gives you options, right? It's not just focused on one or the other. It's a good balance, right? And looking at specifically at this slice, you have almost a 6% dividend yield, a decent, I mean, not great return over the last 5 years, but an okay expense ratio. It's not great, but it's not the end of the world. Let's take a look at your monthly dividend REITs. Your monthly dividend REITs, you got Realty Income, FRT, so Federal Realty and this is, if I'm not mistaken, this is actually a quarterly. This is not a monthly REIT. It's also in my portfolio. Stag definitely is. Maine definitely is. Duke Realty, I'm not 100% sure, but I know AGNC is. So, yeah, I like the fact that it only makes up a small percentage of your portfolio, only 5%. When it comes to this, and I like that you only have AG&C at 5%. This is good. But yeah, these are the rest of these are fine. I have Stag in my portfolio. It's done very, very well here in 2020. It's done really well. Also, Realty Income has, why is this all highlighted? There we go. Has also done fairly well, right? I think FRT is actually down, if I'm not mistaken. Yep, it's down. I remember looking at that. Yeah, it's down. But they haven't cut their dividend. All right, let's take a look at your banks, your finance. You got Visa, JP Morgan, Wells Fargo, Bank of America. I mean, these are big traditional banks in JP Morgan, Wells Fargo, and Bank of America. Visa is a great technology company. I don't think you can go wrong with any of those. Bowtie dividends, you got Dow Inc. Okay. Cool. All right, so Toffee, I think your portfolio, I think it can serve its purpose. I think a lot of people that are looking for that consistent income, this portfolio would not be a good fit because you're going to get a lot of swings. 40% of your portfolio, you're going to get a lot of swings. You look here at the last year, like up and down, up and down. Yes, it's always going up and to the right, but you're going to have a lot more swings when you have portfolio skewed more, in this fashion. I believe, I think Tesla is still going to do great. I think Square is still going to do great. These companies, I think a lot of people watching this channel, I don't know if this necessarily is going to be the right approach for them. Given that this is a Roth IRA and, you have a plan, you have a goal, and this is your goal, I think it can work very, very well for you. I think for the majority of people watching my channel, I don't think that this would be the right approach for most people, but for some people it could work very, very well. And the thing that I like about this for you is you've clearly done your research, you know your goals, and you're going for it, and that's what excites me. When it comes to only being able to invest $6,000 a year, you're absolutely correct. You could, if you were concerned about that, you could reduce your exposure to your ETFs, and you could get more exposure through a 401k, for example, in your ETFs. That would be one idea. Thank you again so much for sending over your portfolio. All right, the last portfolio that we're going to review here is from Leon. Leon writes, "Hi Jake, I'm 22 years old, recent undergrad, graduate from Europe. Currently, I'm working next to pursuing a master's degree in finance, similar to a graduate degree." Yep. I started investing end of 2018 with a little money I had working part-time jobs. That's great. For the past months, I am comfortable contributing at least 1,000 euros, roughly $1,100 per month. But if I do not have unexpected costs, it can go up to 1,500 per month. That's great. Holy cow. You must be keeping your expenses very low. That is great. My goal is to sort of build a hybrid out of very promising growth companies and dividend growth companies and eventually supplement my income with dividends. Unfortunately, I only have a self-made Excel sheet that includes my positions. My account is a regular tax brokerage account. Okay. I have a couple of companies on my short-term watch list, which I'm looking forward to initiating a position during the next couple of weeks. Waste management. I know you love that one. I absolutely do. Everybody watching the channel, you know that I love waste management. Waste management is great. Microsoft, 3M, Qualcomm, and Pepsi. All right, let's take a look at what you got here. So on the left, you got the company name, and you have, if I'm not mistaken, you have 16 holdings. Okay. All right. So you got 3M up there on the top. I'm not seeing the allocation or the weighting. I'm looking for the weighting. There we go. So there's the weighting down on the bottom. We'll see that. We'll look at that in a second. So let's first see what you got. You got 3M, you got AT&T, you got AB and, okay, I'm not familiar with that one. AB InBev. Okay. You got Coca-Cola, you got Facebook. You know what's funny? When I was in Germany, I actually used to bank at the Dividend. There was always they would always do the commercials with Dirk Nowitzki. Dividend, that is so funny. JP, oh my gosh, that brings back memories. For those of you that are watching my channel for the first time or watching this video, you haven't seen my other videos. I used to live in Germany. I almost lived in Germany for almost 10 years. And yeah, man, this is awesome. This brings back memories. JP Morgan, you got McDonald's, you got Merck, you got Microsoft, Procter & Gamble, Skyworks. Okay, cool. Stone, Tesla, UPS, and Waste Management. Okay, so there's a lot of great companies here. So first off, these companies, they're not going to go bankrupt. Like, there's a lot of great established companies here. Skyworks, man, like there's a lot of stuff coming their way here with 5G, with a lot of stuff that is going on. Like really, really interesting. I need to research this company a bit more. I've been seeing them come up a lot. Coca-Cola, great. I mean, you're looking at your hallmark brands. You got your 3M, you got your AT&T, your Coca-Cola. These are great companies. Now, you're a bit young. I mean, you're 22 years old. It's in a taxable account. So you're going to be taxed on the dividends, right? So you have to be aware of that. When you're growing your portfolio, and you have to understand that you got to pay taxes. It's just how it is. And so be aware of that the taxes will be coming in, especially if you're holding an AT&T. This averaged right around 30 bucks, right? Like it's just how it works. Okay. I love that you got waste management down here. Let's see what you got down here in your allocation. So you're definitely heavy or overweight on Tesla, or maybe not overweight, maybe at weight. I don't see the target allocation, but you definitely are heavy in Tesla. You got Stoneworks. What do you got here? You got cash. Okay, that's good. You never, cash. When you see these companies go in a dip, you can pick some more up. Especially like the thing that I like about that is you have really high quality companies. When these companies go down, you can average in when you see them go down and you can really feel good about it. I mean, that's what's so great about investing into such high quality companies. When you see the price go down, most people are getting scared and running for the hills and, oh no, I'm going to lose everything. And then you're coming in there with your cash and buying up all their shares at a discount. I mean, it's amazing. Okay, cool. So what other tabs do you have down here? You got your dividend. So you got your dividend income that you're tracking. Oh, this is so cool, man. This is so cool. You're doing it all in Excel. I'm hoping that propeller.com, it's from dividend.com, is available to everybody soon. It's still in beta. But I also track my dividends in Excel as well sometimes, like the monthly cash flow. It's just kind of fun to do it. Okay, cool. What do you got down here? You got portfolio history. So you're tracking the history of the portfolio value as well, which is great. Okay, so you're tracking your dividends here as well. You're tracking the portfolio value as well. This is cool. Like this, honestly, I love that you're doing this. When my wife and I, when we're tracking our financial independence number, like we're looking at this month over month. I should share an entire video on this. Here in September, my wife and I, we more than doubled our dividends than we had back in June. And it's just been insane to see the portfolio grow. And it's so cool. It's so motivating. It's so motivating to see it go up and up. What do you got here in your analysis? Oh, this is just the analysis of the companies, the dividend increase, and all that stuff. What you can do is, I actually do this in Seeking Alpha. Let me see if I can help you out. You can actually do this in Seeking Alpha for free. So what you do is go to Seeking Alpha. I'm not affiliated with them. Go to Seeking Alpha. What you can do is you can create an account, and then you can create your portfolio, and you can create multiple portfolios, right? You see my different portfolios, and you can have all of that in real time. So everything that you're doing here manually by hand, you can actually have it in Seeking Alpha, and it's updated in real time. And the cool thing is you can filter it by average yield, right? You can filter it by ex-dividend date. Like there, you can, filter it by dividend growth, right? There's a lot of cool things that you can do. I would recommend maybe, if you want to keep doing it with your Excel sheets, definitely do it, go to town with it. But also, this has been so helpful for me to following up on my portfolio, especially where I have dozens of holdings. It helps me to track everything very seamlessly and time efficiently. Leon, thank you so much again for sending over your portfolio. You definitely had me with the nostalgia here with the Dividend Bank, the bank that I used to bank with in Germany when I was living there. Thank you again so much. And the best of luck to you. Thank you so much, everybody, for watching the video. If you're new to the channel, I'd invite you to subscribe. If you like today's video, give me a thumbs up, and I will catch everybody in the next video.